Livestock Watch. He is also a master fellowship with his weekly independent investor. This is something he rolls out daily, and also an independent newspaper every Monday. So he's a veteran. I think we can call him a veteran in this space. And he's going to be joining us today to answer any questions and to attend to any questions you have regarding the topic or regarding any other investment question that you have. Ambrose is an associate member of the Institute of Pension Administrators and fellow of the Institute of Professional Financial Managers, UK. He's also a technical analyst and trained professional in London and South Africa as well. So thank you very much, Ambrose, for joining us. You're welcome to the platform. Thanks. Thanks for being part of this. You're welcome. So in due course, we'll have you respond to questions or chip in as required. Thank you once again, sir. We're happy to have you here.
Thanks for having me. Yeah, and good day to all in the class. Thank you. Yeah.
Yes, sir. Thank you, sir. Okay, so we also have, leading the topic today, investments versus trading. We have Bimpe Ogundelu, who is our head of research. You've met her several times. She's led some of the sessions we've had here a couple of times. So she's not a new face, except if you're just joining us for the first time. So Bimpe will be leading this session. Bimpe manages the research department of Arthur Stephen. She's a chartered stockbroker, associate member of CIS, and she's also an authorized dealing clerk as well. So we're going to be listening to Bimpe and having her lead this session very briefly, after which we'll have questions. Our rule is really to have everybody mute their mic. If you have questions, please drop them in the chat room. Drop your questions in the chat room, and we'll have those questions addressed right at the end of the session. And we'll also have Ambrose, who is our co-host. We're going to have him as well also join us in responding to questions. So thank you very much. This is also to let you know that this program is being streamed live on YouTube. So if you log on YouTube, you can also have this. So you can have access to this right after this program. You don't need to ask for a link. You just go on YouTube, go to Arthur Stephen Asset Management YouTube page, and then you have access to this recording and other recordings we've done in the past. Thank you very much. So now I'll hand over to Bimpe Ogundelu to share her screen and deal with the topic of today. Thank you.
Okay, thank you very much, Efe.
In responding to questions. So thank you very much. This is also to let you know that this program is being streamed live on YouTube. So if you log on YouTube, you can also have this. So you can have access to this right after this program. You don't need to ask for a link. Just go on YouTube, go to Arthur Stephen Asset Management YouTube page, and then you have access to our today's recording and other recordings. So now I'll hand over to Bimpe to share the screen.
Hello, Bimpe. Can you hear me? Hello, Efe, please.
Thank you very much, Efe. So thank you very much for letting this program is streamed. So you log on YouTube, you can also have this. You can have access to this right after this program. You don't need to ask for a link. Just go on YouTube, go to Arthur Stephen Asset Management YouTube
Please, the speaker is not audible enough. We are not hearing you. Hello.
The speaker is cracking. We can't hear you. Look at your speaker. Yeah. The voice. The voice. Yeah.
Sorry, there's some issue with the mic.
It's humming. It's humming.
Bad. Please,
The speaker is humming.
Okay.
It's humming. Yeah, it's humming.
Okay. All right, no problem. All right.
It's not. I can't hear you. Look at your.
Now. Hello. Okay, can you hear me? Okay. Hello, can you hear me?
So, can you hear me?
Yeah, it's better.
Okay, I can hear you. We can hear
Please,
you.
what about you? It's better
Yes,
now.
I think I can. Yes, I think it's better.
Okay, so you are audible now. Please, you can continue.
Okay, thank you very much. Sorry for that. I just want to be sure everybody's with me before I go ahead. All right. Good evening, everybody. Good evening. It's nice to be here again. Thank you, Efe, for the beautiful introduction. I'll just go ahead to the webinar. Okay, so today on this month's webinar, we'll be talking about investing versus trading. So we want to try and understand the concept of what investing and trading is. We want to bring this understanding to you as our clients. So I'll just be going ahead. Okay, so what is the objective of today's webinar? What's the objective? The objective is that, yeah, I can hear you. So the objective of this webinar is for you to understand the terms investing, to understand the terms trading. Be able to understand the terms trading, understand the difference between investing and trading, and understand which strategy is more appropriate. So what's the general overview? So the general overview, investing versus trading. So the term investing, so you know, a lot of people actually use these words interchangeably. You say I'm investing, I'm trading, but there's actually a difference between the two. There's a difference between investing and trading, and this is some of the things that we want to try and iron out in this webinar. So now, what is investing? So investing is a financial strategy with the aim to build wealth over a medium to long term. So when you are talking about investing, the aim is actually to build wealth over a medium to long period of time, is to be able to build wealth over a long period of time. So, and investing also involves adopting a buy and hold principle. So it means that you buy a particular stock today, probably because of some fundamentals or some basic factors, and then you hold it for a period of time till you are able to get the value for which you actually bought it today. Investing also involves holding assets for months, for years, or even decades, just as I explained earlier, to take advantage of benefits like interest. So if you are holding an asset class like bond, you definitely get a benefit of having a consistent interest, paid to you over a period of time. Then for stocks, you have dividend. That is a consistent, that's a return on your investment over a particular period of time. You get a cash payment. And we also have bonus. Some of benefits also come in terms of bonus. When such a company issues out bonuses, benefit from it because you are still holding that particular stock. Another benefit is also capital appreciation. So capital appreciation is whereby the price of a stock has risen, has appreciated beyond when you actually bought the stock. Okay, investing also involves investing in the future of a particular company. So when you are investing, what you are simply doing is investing in the future of a particular company. So it means that you have seen the future today and you know that, okay, the future of this particular company is going to be is bright. Let's put it that way. It's bright for tomorrow. Things are going to work out well for this business tomorrow, and then you put in your money there because of the value, the future value you are actually seeing in that part. So the fundamental of that company, you need to really understand what the business of that company, what kind of business are they doing? Is this business actually sustainable? That would actually inform your decision, because that's what you are really investing into. So why do people invest? A lot of people invest for different reasons, and I will just be mentioning some of them. And that is for creation of wealth. The basic purpose of creating wealth. So we have a lot of different objectives, and irrespective of your objective, it is actually to create wealth over a particular period of time, to make sure that you don't just have that particular money you still have today, next year. Okay. Another one is because of the good fundamentals of that particular company. When you see a company that has a good fundamentals, that has a good future, then and you have spare money, you have money, then you can always want to put your money into that kind of company, because the company has good fundamentals, because the company has good prospects for future growth. Another reason is inflation, because there is this saying that time value of money is very important, because the amount of money, the 30,000 naira you have today is not the same as what you have in 1 year time. In fact, even in 1 month time, and that's simply because of inflation. Because as inflation keeps rising, the value of that money, your purchasing power actually reduces. And because of this, you want to beat against that. You want to beat against inflation. And these are some of the reasons why people also invest, such that they are even able to get a return at times that even beats the inflation rate. So at that 1 month time, my money has even grown even much more than the inflation rate of what period. And then because of steady income. So steady income in the sense that you get a consistent dividend for over the years. Some companies actually pay dividend twice in the year, the interim and the final dividend. why some actually pay just once a year, but you are sure that there's something coming to you every year at a particular return, at a particular rate. Okay, so we'll just be looking at, so this is a typical portfolio of a typical investor. So as an investor, and you want to actually, create a portfolio, you want to build a portfolio. These are some of the things that you will want to, put in your portfolio. So we have the large cap stock, which actually takes half of the portfolio. And what are large cap stocks? Large cap stocks are actually stocks that they have a market, they have an high market capitalization. The market capitalization is higher. Market capitalization is simply the outstanding shares of a particular company multiplied by the price per share, the price that the stock is trading presently. And some of these kind of assets that fall into this category in our exchanges, the likes of Dangote Cement, we have Boa Cement, we have Airtel Africa also. And one thing about this stock is that they are actually defensive stocks. So for someone that you are actually risk averse, you don't want to take too much risk, and yet you still want to invest. So this kind of stocks are actually good for something like that, because they actually determine the direction of the market. They mirror the market. So for something like that, you also want to put your money. Then we have the mid cap stocks. So these are stocks that actually have. These are stocks that their market capitalization is not too large, and at the same time is not too small. So we see the likes of GTCO fall into this kind of category. And this because so now large cap stocks, they also come with the fact that their prices are usually high. Like when you look at the likes of even Nestle, the price is going for about 1,000 naira. So the prices are high. So they don't get to move. The prices don't get to move faster like that of a small cap or a mid cap stock. So it means that even the risk is actually low, and then obviously the return is low. And one more thing is because the prices are high. So even when they pay dividend, a lot of times the dividend yield are usually low, but at least you can be sure of getting a consistent dividend, because these are stocks that also fall in this category as stocks that they are actually in their mature state, so they have enough earnings to even pay out dividend. So, and then we have the cap stock, and then the market cap stock. Market cap stocks are stocks that their market capitalization is actually low. So I'll just put events. So there are stocks that they have a market cap of below 60 billion. Why mid cap stocks that have a market cap of between above 60 billion and a trillion. Okay. So now, what are the key metrics that we want to look out for as an investor? So I want to invest. Okay, you've said I should look at this. What are some of the key metrics that you want to look out for? So these key metrics are actually called, the fundamentals. Because as an investor, an investor is actually particular about the fundamental of that particular company. What are the bases? What is the profitability? So now we look at the price to earnings ratio. So what is price to earnings ratio? Price to earnings ratio is simply the current share price of a particular stock divided by the earnings per share. So earnings is also same as profit, the net profit, the net profit of a particular company. And what does this actually measure? So price to earnings ratio is actually one of the most important and key ratio that you need to consider as an investor before going into any stock. So you want to be sure that because it helps you to determine if a particular stock is overvalued or undervalued, and you want to be able to determine, okay, what stock should I buy? So by saying overvalued, it means that the stock is actually trading beyond its value. So the particular value of this stock is 15 naira, but currently it's trading for 17 naira, and you don't want to put your money in that kind of stock, because you know that this is not the true value of this particular stock. So the lower the PE ratio, the better. But you cannot use this as just a standalone ratio. It is used in comparison, depending on what the standard ratio for that industry is. So if the standard ratio for the industry is 5, and then you are having a P ratio of say 2, then you know that, okay, yes, this is a good one to buy into. Another one is the price to book ratio. So price to book ratio is simply the price of the share price of a particular stock at the time divided by the book value per share. So when we are saying book value per share, that is the net asset of that particular company. So the net asset is simply the total asset minus the total liability. And so what does this measures? Price to book ratio also helps us to determine if a particular stock is undervalued or overvalued. And price to book value tells you, okay, what is the return, what is the amount, what is the price of this stock in relation to the assets. And that also gives you and you cannot also use some of these ratios. You use them in relation to the industry average. You want to know what, or even a similar peer. So when you are considering a GTCO, for instance, you want to also look at the price to book ratio of a Zenith, because they are similar, they are peers, and you want to compare it, and that will actually give you an informed decision what to put your money in. Okay, another thing is it tells you how much of the capital of the company is being invested in debt, is being financed by debt. That's simply by borrowings, and how much percentage is being financed by equity, which is the shareholders fund. So you don't want an instance where a particular stock. So the lower the better. So you don't want an instance where when a company actually has when the debt to equity ratio of the company is actually high. So you see, for instance, 70% of the capital of the company is being financed by debt and 30% by equity. Then there is actually a red flag that you should know, because that information means that in the case of the company, liquidating, there could be little to nothing for you as an investor. So you want to be sure that the debt to equity ratio is actually also low. That is, the amount of the capital being financed by debt is actually lower. Okay, then we also have the return on equity. So the return on equity simply is the return that you get as for investing in that particular company. So what that actually gives you your return on investment. Also, you cannot say that it's the return on your investment as an equity holder, as a shareholder. And lastly, we have the cash flow. Cash flow is very important. You need to be sure that the company you are investing in, has enough cash to be able to finance operation. So when the free cash flow is positive, that signifies that, this company actually has enough cash to actually run its business, because you need to be sure that the company you are putting your money to has the ability to run its business, its day-to-day activity by itself. Now we move to trading. So what is trading? What is the term trading? So trading is a financial strategy that involves generating profit over a short period of time. So a trader is not interested in the long term. It's not interested. He's just interested in generating profit for a short period of time. So he actually buys the asset at a low price. Even trading can be as much as a day. We have traders that actually come into the market in the morning and leaves before the close of before the close of the business. So the intention of this person or of a trader is to actually buy at a low price and sell at an higher price, and that's actually how a trader makes his profit. But the key word there is that it's short period. It could be as much as a day, a week, or a month. But the trader is not looking to the fundamentals of what the business. Even as a trader, you are not even concerned about what business is doing. Is the business viable? Because you are not waiting for a long period of time. You are not waiting grow, for the company to grow and to add value. Okay, so trading also involves trading trends. So what is actually majorly used in trading is actually to trade the trend of the market. So a trader looks pattern at which the price of a particular has actually grown or an asset has grown over the years and wants to actually trade with that trend. So the analysis that is majorly involved here is the technical analysis. Okay, so this is a portfolio of a typical trader. Because he's a trader and he's not so much interested in value, not so much interested in the value of that company. So he wants to do 10% of a large cap stock. He wants to do 20% of a mid cap stock and 70% of a small cap stock, because the cap stock gives you cap stocks are actually very volatile, as much as because they are lowerly priced. So you can see a cap stock going for as low as 50 kobo, as low as 2 naira. So the rate at which the price moves is actually faster. So for a stock that is going for 2 naira to move by 100% is faster compared to a stock that is being trading for 200 naira. And in that case, the trader is able to quickly take his profit and exit the market. So you want to do more of this. You want to have more of this in your portfolio as a trader. So what are the key metrics to look out for as a trader? Some of the key metrics. So that is the moving average. So moving average is just like a plot, a line plotted to give us the average price of that particular stock over a period of time. So for a trader that is just a day trader, or a person that is just a day trader, you are looking at, okay, what has been the trend of this particular price over the day. For a person that is actually over the day. So that is simply what moving average does. It's one of the key technical analysis that you actually use, to be able to know, okay, so once you know the moving average, then you can know when to buy. It gives you the right direction as to when to buy and when to sell an asset. Another thing is the relative strength index. So the relative strength index is actually an indicator that helps a trader to know when a stock is overbought or oversold. So when you are saying overbought, it's also the same thing as saying that the stock is is overvalued. The stock is overvalued. That I explained that earlier. That when you say a stock is overvalued, it's simply that it's value. So it's not trading at very value. And you can also say that the stock is actually expensive, and you don't want to buy something expensive, because the goal of a trader is to actually buy low and sell high. And when you say that a stock is oversold, you can also say that the stock is undervalued, that is, it's cheap. So a trader is always watching out for, uses the RSI to watch out for when a stock is actually overbought, and at that point he knows that, okay, it's a good time to sell, to exit the market. And when it is oversold, it's a good time to actually buy into that particular asset. Okay, so now we move into the differences. So what are some of the differences between an investor and a trader? Okay, so who is an investor? So we're just going to be looking at some key metrics, and then so what is the objective? You know, as a the objective of an investor is actually long term. So you possibly have a long term objective. You possibly have, so this can even help. Maybe you have a project to do in the next 2 years, in the next 3 years, and there's an objective for that. So you could actually, start investing, putting that little fund into big so as to meet the objective at that particular time. So the objective of an investor is actually for a long term. While for a trader, it's short term, as I said earlier. He is not waiting for a long term. He doesn't have anything to what his objective is just to make profit at that particular at the very short time. Why for an investor to actually make profit on a in a long period of time. Okay, so we also have the timing. So as an investor, it actually requires less time to monitor. Investing actually requires less time to monitor. It's something that, because definitely prices move up and down because of market sentiment, but an investor is not really concerned about that because he knows the value. You have done your assignment, you have done your due diligence, you know that the value of this stock is actually going to be this in some years time. You know that, this company, so you are not really concerned about what the price is doing, if the price is going up today, if the price is coming down today, as long as it's not a key information that can actually even threaten that particular business at that particular time. So close of business that day, then he obviously has to be in front of the system, monitoring what the price of that particular stock is, so that as soon as the price rises to the level that he has anticipated, he can quickly exit the market, because we know that prices of stock of some of these assets, except it's a fixed income security, they vary. They vary even within a very split of seconds. Another thing is analysis. So if an investor is looking at fundamentals of business, doing more of fundamental analysis. So you are doing more of looking at the of that particular company. You are doing more of looking at the price to book ratio of that particular company. You are doing more of looking at the free cash flow to ensure that this company actually has enough cash to run its operation. Why for a trader, looking at the technical analysis, which is the moving average and the RSI. So the risk and the return. So the risk for an investor is actually low. And if the risk is low, it obviously means that the return is not also going to be high. Return is actually also steady. But one thing you can be sure as an investor, as long as you are investing in a dividend-paying stock, you are sure of a steady return, in the year. You are sure of a steady return, say a 10 to even 10%, 8%, depending on how well the company are paying out that dividend. But for a trader, the risk is high and the return is also very volatile. A trader can come into the market with particular capital and lose that capital and even run into loss. And at the same time, it could even make triple of that money at that same time. So the higher the risk, the higher the return. And this is just because it's actually for a short period of time. And also capital. So the capital required to carry out investment, to start investing actually low. Like for us here at ASAM, you can start investing with as little as 5,000 naira. You can open a trading account and start investing. But for a trader, you need large capital compared to investing, because you can't put in 5,000 naira into the market today and expect that before the exit of the market you are getting something very high. So for you to be able to make a large margin, a large profit, you actually also have to put in the capital. Okay, so which strategy is more appropriate? Is it investing? Is it trading? All right, so there is actually no strategy that is more appropriate. There is no good or bad strategy, whether investing or trading. There is no one, because the both of them, investing has its advantages, has its disadvantages. Some has also trading. They both have their advantage and disadvantage. So what will actually determine what strategy is better is depending on you as a person. It's depending on some factors. It's depending on you as a person. So one thing that will actually determine which strategy is best for you, which strategy you should employ, is the financial objective. What is your financial objective? So, for instance, for someone that want to invest because, okay, maybe I want to pay I want to be putting this particular money so that I can meet up my rent obligation in a year's time, or I have a particular course I want to run in 3 years' time, and I want to start investing now so that I can be able to meet up with that cost in 3 years' time. Then you are actually thinking of investing because your objective is already more than a year. You are actually already thinking of investing. But if it's just okay, I want to make little profit, I want to do, you really don't have a definite objective, or your objective is just for a short time, maybe just to just to increase the your wealth just in a short time, then you want to do trading. And also the risk tolerance. Risk tolerance is your ability and your willingness to be able to take risks. A prominent investor once says that money that you are not ready to lose, that you cannot lose, don't even bother investing it. So if you are sure that, oh, this is my 10,000 naira, I don't even, or this is my 1 million naira, I'm not ready to lose it, then it's better not to even put it into the market at all. And if you are that kind of a person that you don't want to lose your 1 million naira, then adopting the investing strategy will actually be very good for you, because you're sure that over a long period of time, as long as this company has a good fundamentals, because you have done your due diligence, then you know that this money would actually grow. There will actually be more value added to your 1 million naira in a year time, even in decades time. But if it's a person who has a lot of appetite for this, then trading will be appropriate for such a person. Another thing we are going to look at is time. So as a trader, time is very paramount. You need to have the time to sit with your stock, to sit with your asset class, and to also to sit with the market and watch trends of the market, because that's what traders actually do. They take advantage of the price volatility. You take advantage of how price moves in a particular time. So you have to have enough time to be able to sit down. So if it's a person that you have the time to be able to do that, then trading would be appropriate for you. But if it's a person that you don't really have that time, you don't want to be bothering yourself about, okay, what's the price of this thing at a particular time, then investing would actually be appropriate. And so at this time, I would just want to introduce our platform, our trading platform. So ASAM actually has an e-trading platform that we provide for our clients to afford them that opportunity to trade for themselves, to take decisions for themselves. And even right now, as we're speaking, you can actually click www.authorstephenonline.com, to open an account if you don't have one. And if you have one already and your trading account is already set up, then you're sure we would be able to trade. But you can actually open an account right now, and we will get that here at our place and put everything in place for you to be able to start trading. So this platform actually gives you, the opportunity to be able to watch the market. You can see what the price of stocks are actually doing at that particular time. You can monitor your stock. You can see your portfolio. So it gives you that opportunity as an investor or as a trader to actually monitor your portfolio. So in conclusion, I would like to reiterate and also say that no strategy is actually, both investing and trading are good strategy for making profits in the financial market. That's actually the goal. The goal of whether you're an investor or a trader is to make profit. Nobody wants to put his money in something that would not give you value. Nobody wants something that won't actually give you value. So the main aim is to make profit. But whichever strategy you adopt, it will be based on your individual choice. And that would actually be based on your willingness to take risks, your willingness to actually lose that particular money or not be able to get as much as that return that you are expecting in future time. So how willing you are to take risk to determine the strategy that you are going to use, and as well as your financial object. Thank you very much. Thank you. Efe, over to you. Thank you.
Thank you very much, Pimpe. Someone just sent me a message and said that said that he actually attended a training on what you're sharing now and had to pay for it. If he had waited a bit, he would have gotten, the amount of knowledge from here for free as ASAM is giving out. Thank you so much, Pimpe, for that. I'm already seeing a lot of comments coming in saying thank you, because you can share.
Thank you so
everyone. Yeah, so I'm going to give our guest speaker, Mr. Omodio, opportunity to take over now before we now address the questions. So like you, sir, from your wealth of knowledge, to just address this topic we're having at this time, just give an overview and speak to those key points. Being a veteran in this space, the pain points of investors, the pain points. So please address those points in your remark and also other things you want to share. Thank you very much.
Yeah, thank you very much. Yes, I want to say big thanks to my co-pilot for today. She has done a good job. I say top up for you, my sister. God bless you. It's a good one. I think we need more of this in this market. And what I thought people have started is a good thing. And I think others should copy. Let's educate Nigerians on how to invest wisely in this market about education. Anything you are venturing into, you don't have education, you are doing trial and error, which I will not encourage anyone here. You must have knowledge and insight of what you are doing so that you can take advantage of the market. And also to look at the topics for today, investing and trading. These are really what the market feed on. Either you're a trader or you are what? An investor. But I will start with saying that whether you are investing or trading, you must know yourself. Don't allow the market to give you a direction. Because if you allow the market to be an expensive place for you to be, you must have a goal from the one. Like you just said, your financial goal or your trading goal should come first. Because if you allow the market to dictate for you, it's a very, very expensive place. That means you have to use your money to learn, try and error for a long time. No. This is time from the one, set a goal. If you want to go the way of investing, want to go the way of trading, you should know. Don't allow the market to dictate for you. Because that is where you'll be burning your fingers, losing your money because you don't have direction. No, have a strategy to come by what? Following a goal. That goal will tell you kind of stock you have, the kind of stock you buy, and kind of time you're going to spend in the market. I should mention time because if you are the type that work from 8 to 5, the kind of stock you buy from the guy that is sitting at the front of the laptop to 4. That means you need to understand the kind of person you are. That would be a good way to start. Either you are investing or you are trading. That means for us here that are in this class today, as I said earlier, whether you are investing or trading, you should not allow what the market to dictate for you. Know yourself first before you venture into the market. That is the way to start. But for investing and trading, if you want to invest, become an investor. If you are trading, become a trader. And these two words are used categorically, as I said, in the market, but will have different objectives. And that is why you see we'll have different market sentiment, different market direction, different market attitude, psychology, because of this type of people in the market. They are there people that are investing for, and this investor is not only individual. There are some companies that they are there for investing. because a PFA is not ready to gamble. The PFA looking for company that pay dividend for 5 years and consistent to put money. You can't call that kind of non-institutional traders. There are some also top looking firms that have their proprietary account. They trade to run the cost or the management or the finance operation of their company. These people are in the market for different reasons. And that is why you as an investor or trader, you must know why you are what in the market. And I will start by saying investors look at what the companies, they want to do evaluation. And what do they do when they're looking at company? Look at company product, they look at the P ratio as I mentioned, management, look at the balance sheet, look at the supply chain distribution and the future of this company. This is what an investor wants to look at, because in thinking of how this company will go in the future, as I said, to depend on dividend, bonus, or capital appreciation that come with it. But a trader must set a goal. An investor must set a goal. And if you're in the market with that goal, you have failed already. That means it is that goal that you have will also guide you, as I said earlier, the kind of stock to position in. And traders also look at, a trader in the market is looking at the stock. I said it that investor is looking at the company, why a trader is looking at the stock. Why I say stock? The guy trading is looking at the price of the stock, looking at the volume, looking at what? The sentiment in the market, looking at the psychology and looking at the demand and supply. Why if investor is looking at company, trader is looking at what? Stock. I'm looking at stock because you want to know the supply and demand of that stock so that he can make move. Why the guy that wants to invest for us, looking at the company fundamental, who is the manager, how long can the company stay, what is the fundamental? The good thing is that even the trader that is looking at the stock, there's a way that the fundamental activities was going to influence his decision, but it's purely looking at activities, momentum, sentiment in that stock. That is why you see the two are different, but they are in the market to achieve the same goal, creating wealth for themselves, achieving some financial goal and success. That is why they are in the market. And for that, as a trader or investor, your goal is key. And I believe people that are here that always follow us, always remember that your goal is key. Don't allow Mr. A that want to make 100%, that you have set 20% to deceive you. No, you are in the market with different objectives. All of us are playing the market. Let that your objective guide you. If you make your 20%, please, my brother, sell off your stock and move for another one to move. If you are spending for 10%, 100%, you'll be waiting. You have gone in and out for a trader more than 3 times in another different work. That means that's your goal is a key, because it will trickle down the kind of stock you buy, the kind of sector you should play. As you just said, the high cap, the medium cap, and the low cap, it is your objective. If you're a trader, you know that you can't go to all those high cap stocks because the way they move is very slow. But if you are in all those medium cap stocks, those low cap stocks, you make money. In our market today, let's take an example. The market is already on a rate of about a negative 3.58 or 56. But there are some individual stocks, especially those low cap stocks and medium caps, are putting us more than 100% just year to date because price movement and activities. That means as a trader, set a goal and the kind of stock you buy. Once you do that, you are good to go in this market. Like I said, these are the things you feed on as a trader, because the trader look at company, look at company what? Stock, not the company activities. But that company activities has a way of influencing the stock. The stock is that what is the demand, what is the value, what is the time? Because in equity investment, a trader is looking at price, volume, and time. When I mean time, that time is part of what? Seasonality. So when I mean seasonality, they are comparing the time of they give volume, they give their dividend, they pay the mark down. A trader wants to know all this. That's why in a technical analysis, price, volume, and time is very important. I didn't say timing. Time. When I mean time, you need to know what season things happen in the market. This is what a technician wants to feel like, because the chart will reflect all this. But an investor will want to invest and go asleep because the company has a good business model, it has future, it has the sector is operating is okay, which are also going to support the trader. But the trader is looking at what is happening in this market, what is the forces in the market, what is the momentum between the buyer and sellers. These are what determine price. That's why if you're an investor here, you're a trader here, nothing stop people having two accounts. Don't say because I'm an investor, let me say to the investor. No, you are in the market to make money. You can still have your long-term investment objective and portfolio, and have also your short-term investment to make advantage of the market. That means if you are buying some stuff for keep, for hope, for long term, buy the ones you want to trade. If you are in stock like Nestle, because it's defensive in nature, and you are sitting down in Nestle cannot move from the price of 1,400 to 1,800 in just short time. But a stock that you are trading can move from 1 naira 80 kobo to what 3 naira. You have made almost 80%. That means you, as a trader or investor in this class, draw a line. Those projects you have that is for long term. That no investment go to them is for long term. But you need to generate money for that long term. That means for trading, you have to generate that money to meet that long term objective. But you are buying some stock that will help you to keep it to that long term. You are buying them. But the one that you can trade in and out to support that project is what you are trading. That means don't say because I'm a long term investor, you keep those stocks, you will make much money. Have a portfolio that then you now have your trading portfolio so that you can use it to generate money quickly to support your long term objective. You must balance the two. Don't say I'm only a trader. There are some things that you can enter, your expectation is not yet coming to reality. You don't sell off and run out of it. What you don't do, you can extend the waiting in those stocks while you are still trading others. That means you must balance your portfolio with short-term trading stocks and long-term. Don't say I want to do one only. No, you must combine the two to take advantage of the capital market. Capital market is where we create wealth. Because we are creating wealth, you don't leave chances at all. Don't say because I'm taking long. No, have long portfolio you are running, have your short-term. Only that you need information. Most of us in the market today, I will tell you any day, anywhere that we know when to buy, don't know when to sell. We're all looking at what I want to make 100%. No. Like people are telling me that, oh, Ambrose, your strategy invested has turned around. I say, fine, yes, because people now, if I invest in, tell them that if I can beat inflation, those that are thinking long term that are risk apart, they want to put their money in money market. Yeah, it's also good.
Seems we've lost Mr. Modio. Mr. Modio, are you there? Okay. I think we've lost him. So
probably he's having a network issue.
Gets back, we can just check if we have. Thank you so much, Mr. Festus, as well. Thank you so much for your feedback. And Mr. Emmanuel, so there are opportunities to invest in companies abroad via your platform.
Okay,
opportunities
so
to invest, yeah. Please.
We do not have that that platform because we don't have the license to invest in companies abroad. But one other thing that we can do, because something like Airtel and Seplat, they are dual listed, so they are not just listed on the Nigerian exchange. They are listed on the Nigerian Exchange Limited and also on London Stock Exchange. So you might want to take advantage of that, since Airtel, Seplat are both listed on both exchanges. But as to us having a license to trade on global stocks, no, we do not have that license.
Okay, I'm back. Sorry for that. Yeah. As I was saying, that we must have a balance. You must have a balanced portfolio. Don't just because say you are an investor or you're a trader, have the two, combine the two. When you combine the two, you can take advantage of the market. And combining the two, you need to combine what we call technical and fundamental analysis. As you have said, it gave you those fundamentals, but you need to combine these two anywhere in the world. Those that are making money in this market, globally and locally here, and those that play effectively with what combination of fundamental and technical. That's why I said you must have the two portfolio. Whether you are thinking fundamental, have the two portfolio. My trading portfolio and long-term portfolio. Those fundamentals will help you in the two portfolio. Technical will help you in the two portfolio, so that at the end of the day, you become a better investor and able to create that wealth that is your goal, in the market, because the market is wide open. And that means, as you just said, I want to give you just a strategy for traders. Traders in the market, I'm going to give you 3 pillars that you should do as a trader in the market. The first thing, as a trader, we want to look at what is the general trend, because a trader is not interested in the name. We are not marrying stock. What is the trend of the market and the trend of the stock we are looking at? Once we're able to identify that trend, you have established a trend, you can know what to do. That means the trend is coming up. Also look at, is there a breakout or a fake out? When you're looking at a breakout, you have to look at your support and what at the stand level. Then you're looking at your chart, your chart there. Your chart action. When that chart action, are looking at what is the price and the volume and the timing in the market. Once you can do this 310, this 310 is strategy enough for you to know. And also, we go further, what to buy, what to sell, and the time to buy it. It is your technical analysis, your indicators, and these indicators have to combine price, volume, and time. Again, that means you have to train yourself to know how to use technical analysis using all those indicators, moving average, MACD. Their names they are plenty. They are okay, but the one that suits you as individual, that you understand both, is what you use. In investment data, we don't use all the indicators in technical analysis. The one that confirm our decision faster, and that what you do. That means if you really want to take advantage of the market, you must also come up in that knowledge, in that aspect of technical analysis, the knowledge. You need to up your game in that knowledge by learning the techniques, not just having to know trend. No, there are other things that you need to know technically that will help you. For fundamental, it's easy. Look at your P ratio, look at company fundamental, the future, the balance sheet. Fine, but if you want to make money, you have to look at your technicals. It's very, very key. You need to know the wave in the market, you need to know the momentum, you need to know the sentiment. But all these are tied down to what? Indicators. Those indicators will help you, but you must understand the market direction. Also, don't forget that when there's no liquidity in the market, it's also a problem. But a technician will know when there's no liquidity. That means you won't be caught off in anything because it sees what is happening in the market. Like those that follow us in the what we call money flow index. It's a key indicator to watch. When funds are leaving the market or funds are leaving individual stock, it will give you a signal. When funds are coming back, you will know. I know that it is funds that drive price. No matter how good the company fundamental, if there's no liquidity in the market, the price cannot jump overnight. There must be liquidity in the market. That means that liquidity is a kind of a strong fundamental that every investor is looking at. Now that in the last about 3 weeks now, you see volume in the market has been so low. Ask yourself, price are just moving gradually, and market is pulling back just little. Market just lost about 0.5, 0.0 this, but you see the volume are small. It tells you that there's no liquidity in the market, and also people that are positioned before now are not ready to exit because they see that there's opportunity ahead of this market. For example, the government want to borrow more, and also the treasury bill market can see that the last option is still stable at 7.20. And also the government want to borrow more, and if they want to borrow more, actually before now, you know that our cost of servicing our debt is already high. And if they want to borrow now, they can't carry their rate of borrowing up again. It will become a bigger problem. Government would like to borrow at a lower rate. If they put that means rate from their borrowing might not be up. That means it will kind of discourage people to enter into most of these their instruments. That means equity becomes the right place for them to look at. That means you as a trader or investor, if you're in a stock now, look at those dividend stock that will give you high dividend yield and capital appreciation. Because if institutional investors are coming back to this market after studying the Q2 number, studying outcome of MPC meeting, studying the last PT, what's it called, treasury bill option that was done, they might likely start moving their fund gradually to equity space. That means if you have to be in that equity space before they start coming. And also, we are lucky enough that we're already towards the end of the third quarter. That means from the next quarter, which is the first month in the last quarter of the year, October, we're expecting this company that had December as year end to be releasing their third quarter to the market. Those that has March during their second quarter. That means another earnings season is ahead. You don't need to wait for anything to start buying as you are seeing results. As a trader, you need to position ahead of any season. Why investors want to look at the numbers and say, oh, can this company afford to pay good dividends from the numbers I'm seeing in Q3? They will now be coming aboard. You as a trader, you have entered before them. When they start that numbers is, oh, assets will pay good dividends, they start coming. You're already in the market. So that means guys will go up, you make your money and come out. That's how a trader invests. A trader don't wait to see the number before you jump into any position. A trader position ahead of what the expectation, because every investment, either in a fixed income and equity, is against what expectation. That means you have to position before that expectation become real. If you are waiting to see the expectation, you are not going to make money because that's what has happened. You need to position before you see that expectation. That is how to go about investment at this point. For me, like those that follow me, we are not afraid of the slowdown we're seeing in the market. It's expected. Like I tell you that the month of August and September are very dicey months. Luckily, month of August went positively, and we can say between now and end of the month, this September can also end positively. But October, November, December are really the buy position ahead of the end of the year and the next year. Knowing that Nigeria market, our our peak earning season is what in Q1, where company that has December year end will be paying their dividend, and that dividend has a lot of way to attract funds into the market. And that means from October, people start buying into all these companies toward the end of December. You, as a trader that's in this house, in this meeting now, you know how to move your money from one stock to the other, looking at what? Morning, because we are in the stock to market to look at morning. All we are looking, all of us here sitting down or online is for us to make money in this market. And it is this kind of platform that we are sharing this strategy, and after Stephen has a house, you can also contact them so that they can explain better on how to do it. You don't need to stay alone, and that is why you're already in this kind of gathering. For me, this is how to go between now and end of the year. It's a lot of opportunity in the market. Don't look back, just invest wisely and let your goal guide you. Have a good strategy for yourself. That is the way to go. Thank you.
Wonderful. Thank you very much, sir. Thank you, sir, for that insight. Thank you for adding that. Okay, I'm just trying to catch up from, okay, so Mr. Douglas says, thank you very much, Bimpe, for this great presentation. Thank you for your feedback, sir. We really appreciate that. My view is that both channels, investing and trading, can be maximized. Absolutely. Thank you for that, Mr. Penny. I don't know if there are other questions. Is there anybody that has any question? Just raising up their hand. So does anybody have any question they want to ask? We have Mr. Model here. It's not very easy to catch a veteran like this on this. So if you have questions, otherwise we'll say Bimpe is a good class teacher. He shall taught us well that we don't have questions. If there's any minute, we can have just a few questions to take before we close. Remember, once again, we have our website in the chat room. You can log into www.atostevensonline.com to open an account with ASAM if you don't have one, and this gives you direct access to our e-trading platform. We have recently upgraded that platform so you can do a lot more. You can, all that we've learned today about being strategic with your portfolio, it's very important that you go in and test it yourself. You don't have to wait for someone to do things. You can watch the market. There's a lot of insight and information on the platform that you can use to make strategic decisions, and that will help you position, optimize your portfolio to so thank you very much. Thank you, Mr. Modion. I think we don't have any more questions. Thank you, Mr. Wale. You've been a consistent participant on this webinar. We see you, we appreciate you. Thank you to everyone who has taken out time to join. I know that you're busy and you have to.
Hello, I have a question.
Okay. You can
have a question.
Sir.
Yeah, my question is trade commission, all this commission have a way of impacting trading negatively, especially if you are not a stockbroking house. Stockbroking house can do a lot of trading and not bother about, because the commission will come to that house. But ordinary traders like us, you will need to be careful. If you buy, you pay. You sell, you pay. So it has a way of impacting trading negatively. You must wait for some time, or else you end up losing. What do you see to that? What comment will you? How will you comment about that?
Okay.
Mr. Modion, you want to take it?
Yeah. For me, commission is never the problem for a trader, because before you start trading, you have a goal. You also have factored in your commission. Only that what I expect you to say that we bargain for a lower commission, and which most of this online platform has really infused in their platform, their online tenders. If you trade online yourself, you pay lesser commission. But the good thing is that as a trader, as you are picking your stocks to trade, you are factoring in your in and out charges for that, so that when you meet your target, you come out with profit. Like in Invest Data, we do buy and sell signal. we know that we'll have a stop loss, we'll have a buy range, we'll have a profit target. That profit target, once you meet it and you are selling, it has covered both your charges and in and out, and also there's a profit on it. That means what you do as a trader, that when you are taking position, if you are buying a stock for 2 naira, and you know that there's commission in and out, it can be 2 naira, 10 kobo, or 2 naira, 15 kobo, you take as your cost. So that when it hits 270, you are, even when you are selling, you are selling at a profit because it will cover both costs. But it is when the charges decide. That's why if you're a trader that you are starting, you need to discuss with your broker, but it isn't when you have volume, I can discuss with them. But factor in your charges in and out into your price you are willing to buy the stock at the initial time, because you have seen a trend. That's why a trader look at trends, and that trend will take you further, will cover your charges. You can't say because the charges is high or low, you want to stay out of the game. No, you a trader, you know the risk it takes to be a trader. You have taken no charge of your portfolio decision you have made that I have to make money. You are going to cover the charges from your trading. As you just said, it might discourage few people that are not knowledgeable about trading. But for me, charges is not an issue in trading, because we have already known from the one that you have an element of in and out transaction costs that you have to take off from your profits. Is that okay, sir?
Okay, Mr. Dedina, I don't know if that answered the question.
Okay, sir.
Okay.
Thank you.
Yeah. Okay. All right. Great. So thank you all. Thank you so much.
Okay. Sorry. If yes, it is okay. It is okay.
Yeah. Okay. Thank you. Yeah.
Okay. If just permit me to say a few words. We thank everybody for joining us at this webinar today. Really, the essence of having these regular webinars is essentially to ensure we are sharing knowledge, because investment generally, and particularly investing in financial assets, is information driven. Whether you're going to be successful or otherwise will be determined by how much information you have and how quickly you do get those information, and how you are able to process those information to make decisions. Those are the factors that will determine how successful you are in the equities market. Mine is not to repeat what has been said, but I think it is important that I let us know here that while most of us are good investors, it's not really easy to become a good trader, because it requires you gathering data, it requires you analyzing data to be able to determine market timing and know when to go in and when to go out. Most especially since you are going to be entering into stocks that you have not essentially done any significant work regarding determining the fundamental of the stock, but for which you can still make money. So Ambrose firm Invest Data have made that process of transitioning from an investor to a trader, they've made it easier for people. What they've done is to gather experts who actually gather this data, they analyze them, and they make those data available to investors in various forms on a daily basis. As I mentioned, they do send out daily signals to investor, and what those daily signals do is to say, okay, look, we've done the chart, we've done the technical analysis, and we think that at this particular price and at this particular period in time, you can enter this particular stock. And then when the return objective is achieved, they will also send you the signal to say, yes, now sell these stocks that we told you to buy on so and so date or so and so week. Now, of course, the decision as to whether you want to buy or whether you want to sell at the time they give you the signal is strictly yours. All right, yes. But the work that is entailed in reading the data and coming up with the decision as to coming up with the recommendation as to as the time to enter the price to enter and when to go out. They will assist you with that. Of course, you know, there's a caveat emptor there. The decision whether to buy or sell is yours, but they've done the background work for you. So just the way some stockbrokers such as you know, Auto Steven do send you weekly recommendation that is based on fundamental analysis. They've also done the work for you on the technical side. And I'm also aware that he does regular trainings. I don't know whether it's monthly or whether it's quarterly. Trying to actually teach people on how to interpret technical data. So beyond them, you know, sending the signals to you on a daily basis, they are also training you on how to you know, start doing it yourself or learning how to do it yourself. And it could be useful. You know, incidentally, to be frank, I will argue that the people that are doing technical analysis have probably made more money this year than those people doing fundamental analysis. Not to say that technical analysis or trading is better than investing. No, it's just that you know, market dynamics has a way of you know, working such that, you know, they seems to have done a little bit better than someone that has been investing and have just been relying on dividends. So, for instance, you know, someone that have been relying on dividends have probably made returns that is below inflation for this year. But some people that have, you know, done technical analysis have made returns that is significantly higher than inflation in some of the stocks that they have gone into for this year. Not to say that, you know, they probably have gone into one or two that have not done so well. So, but I mean, just to let you know, as the two speakers have emphasized that, you know, you need to have a portfolio that is essentially made up of those two components. The components that is, you know, targeted towards investing, and the components that is targeted towards trading. I just thought I should pitch that in. If there's any of us here that is that will like to know more about the trading and the technical analysis that investor does, get in touch with us, and we'll point you towards them, and you know, you can start learning that other aspect of the financial market. Thank you very much again for coming, and we hope to continue this series of webinars, and we hope that at least you are you know, learning things that are useful from them. Thank you very much. Thank you very much, sir. All right, it's a pleasure.
Thank you very much. God bless you, sir.
Thank you very much.
Thank you.
Yes.
Thank you very much, sir. That's our MD CEO. Thank you once again for that insight. Thank you so much for chipping in. We appreciate you, sir. Thank you all. We've come to the end. If there are no other questions or statements, we've come to the end of today's monthly webinar session. Please look out for our next edition. Promises to be interesting and exciting. We are open to questions, please. We're open to questions. If you suggested topic rather. So if you have any suggested topic that you feel we can treat on, please, we're open to those topics, and so that we can add them to our schedule and deal with them accordingly. Thank you all once again. We appreciate you. Have a good evening. Thank you.
Please send the link.
Thank you, everyone. Thank you. Thank you for joining me.